It's time. Let's get started here. I want to be respectful of everybody's time. Today we're talking about non-QM loans. And so I like pitch and catch. Like I like back and forth conversations. I don't like lecturing because like it loses people's attention and doesn't keep them engaged. So if you want to unmute and say something, say it. If you want to drop something in the chat, say it. But first off, I want to ask you guys, do you know what non-QM means? Okay. So the QM piece of this is called qualified mortgage, right? And who all knows the 2008 mortgage meltdown, right? So after that, the Dodd-Frank bill came out and they defined what a qualified mortgage is, right? And you got to meet certain parameters to hit that qualified mortgage. Well, when that came out, the people that suffered the most were the self-employed people, the independent contractors, the 1099 people, because they get the benefits of writing off a lot on their tax returns, being self-employed. Well, when you go to calculate the mortgage qualifying income for a self-employed borrower, it doesn't show a lot. So then they can't qualify for a loan. So around 2014, non-QM came out, meaning non-qualified mortgage options. And that gave the self-employed people, the independent contractors, the 1099 people, an option to get financed, right? Because it was a really hard challenge for them to get financed. And Peg, I was just talking to her before the call started, is our resident expert, right? And anybody on our team that has called Peg and said, "Hey, I have something here for you. Can you walk me through it?" I end up getting a call back going, "Peg is amazing," right? Peg broke it down easily for me. And I was asking Peg a little bit before the call, what made her get into non-QM, right? And non-QM. So let's talk. We're going to be talking about DSCR loans, right? That's called debt service coverage ratio. And if you think about it, it's this simple. Can the property pay for itself without them using any of their personal income? So if you have a rental property where the mortgage payment, taxes, and insurance are $2,000 a month, but the rent is 2,400 a month, that debt service coverage ratio is 1.2, meaning it can pay for itself. So the person may be able to buy that property if they meet the other criteria, right? They're using the income that's being produced off that property. If the property's vacant, they can use the projected income off of that property, right? So that's when Peg's going to get into those details a little bit better here in a minute. And then bank statement loans. These are for the self-employed people. These people don't show a lot on their tax returns, but if they gave us 12 or 24 months of bank statements, they'd be able to show the deposits in there as income, right? And then we would use a portion of those deposits to help them qualify because one of the rules that came out in the Dodd-Frank bill was the ability to repay. And so we have to document that the buyer has the ability to repay the loan. And then another person, and this is a live example I had a lady with $8 million in the bank during that window. She wanted to buy her nephew like a $150,000 condo. The bank wouldn't give her any money because she didn't have any monthly income coming in. But with these non-QM products, there's something called asset depletion, which if you have a ton of assets, but no monthly income, they can use those assets to generate monthly income to help you qualify for that program, right? So having said that, Peg, let's start off with, can you talk a little bit about your credentials, who you are, and why you love non-QM?
Thanks, Jeff. I appreciate being able to come on and chat with everybody. I've been in the mortgage industry probably about 16 years. Before that, I was an accountant. But the last probably 4.5 years, I've been doing non-QM. Kind of stumbled into it because they needed somebody to manage their non-QM team and previous employer. And so I said, I'll do it, job security, right? So I tackled it and I found a real passion. I love the fact that there are products out there that will help a borrower who would normally wouldn't be able to get a loan. And, you know, people make the incorrect assumption that these loans are the old subprime loans, and they're not at all. Most of my borrowers have FICOs well over 700 and have, a really good job stability or company stability. And this is just an opportunity for them to get loans where they may not have been able to get loans in the past. So I have a real passion for it. And I always tell my loan officers when I'm talking to them, I kind of just like spill. And so if you need me to stop talking, just tell me to shut up. Or if you have a question, I'm happy to answer. But I love talking about non-QM and educating, and because I think it's an important product out there for borrowers. And my loan officers are going to increase the number of loans they're doing if they embrace non-QM, because it's not just a product when you can't get other business anymore. It's a product that loan officers and real estate agents are going after permanently, because it does increase your business and it does give you an opportunity to provide options for your high-end borrowers specifically.
And Peg, so that's the reason why we're having this call right now, because I had an agent say to me, "Hey, Jeff, I'm not going to refer this person over to you because they're self-employed and they don't qualify." And I went, "What?" Like, no, send them over. Like, let's have that
Mm-hmm.
conversation because they may qualify, right?
Right.
For a bank statement loan program or a DS. We don't know. Like, let's look into it. The other part is like on our team, the answer is never no. The answer is always going to be not right now, but let's
Hey,
help
I
you
didn't know.
use it
You
into.
want me to cover that? Hi.
Hey, hi,
Hey,
Stephanie.
I got your money. I got your. Wait.
Yo, let's mute that. I don't know what's going on over there. Kind of deal she's making. Um, so let me ask you a question, Peg. With the DSCR loans,
Mhm.
right? Those are for buying investment properties, correct?
Correct. They
Okay.
cannot live in them. They can't have anybody in their family live in the properties. It's a straight investment property that they're purchasing or refinancing.
So in a DSCR loan, you have a real estate investor that wants to increase their portfolio, but on paper, their income alone doesn't look like it qualifies.
Mhm.
What types of properties can they use a DSCR loan to buy?
We do have a couple of investors that will do mixed use, so it could have potentially apartments and then retail down below. It just depends on the zoning. But primarily, I usually see either single family residences or condominiums. Even have investors who will lend on condotels, non-warrantable condos, duplexes. They can do up to 4 units. It's kind of wide open. It just needs to make sure that it's zoned properly. We don't really have any investors who will do agricultural in that way, but they'll do mixed use.
Didn't
So
somebody, yeah, didn't somebody earlier say they had a mixed use property they were sending over?
Yes, that was me.
Yep. So what's that property? What's that look like? I heard you say there's a couple apartments and a business in there.
So yes, there's two apartments and it's a little deli. I mean, it's a nice sized deli, but it's only $450,000 for all of that. And it's been in this neighborhood for quite a few years. So
And so, Peg, if that buyer wanted to put that in an entity name, like a LLC,
mhm.
an S corp, could we do that?
Yes, an LLC is a really common way to vest. You have to be careful that, or at least knowledgeable as far as what kind of LLC it is, because some of my investors require that everybody that's a member of the LLC be on the loan. Some don't require that, and some will say, "Is it a layered LLC?" Like if they have an LLC, a master LLC, and it has other LLCs underneath that, those are okay. We can't have a corporation as part of an LLC, but so it's important to know what their LLC is. It's also, some of my investors require that the LLC be for precisely for the investment purposes. So if you have an LLC that is kind of, you have a store and you have this entity and you have that, is you will just have to steer it to a specific investor, which is one reason why Stockton has quite a few investors that we send business to, because they all have different guidelines and requirements. So we have investors that do not require that the LLC be set up for real estate investment. We have some that do. So it's important that we know what that is.
Oh, don't lose. Okay. So, and here's the other part. Setting those up are pretty simple. Like setting up an LLC is pretty
Yep.
easy. So like even if we have the right buyer, we could help them create that, walk them through how to set that LLC up to buy it. Now, the other question I have for you on these programs, we always get this question. What's the minimum down payment that they have to have on these DSCR loans?
It again, it depends on the strength of the file and the borrower, but typically I would say 80% is the average
Okay.
DTA, I
So
mean
80,
average LTV, so 20% down on average.
okay. Okay. And then Jenny, do you have any DSCR examples that you've done since being at Stockton?
I haven't done one here. I have done one in the past, but I do have a non-QM loan that I'm working on right now.
Can you give that example? Because when you hear the real stories of how this works, then everybody can apply it to their life. Like, what's the
Yep.
story you have with a non-QM one right now?
So this individual is newly self-employed. He has been in the same line of work for over 5 years, but he's newly self-employed like 14, 15 months. And so initially he was working with a local bank in Pittsburgh and wasn't getting a call back after he had already put in about $200,000 down as earnest money on this $1.7 million townhome. And so he reached out to Jeff and I started working with him. He's now able to do the program under the bank statement program. And the rate isn't, I mean, it's actually in the sixes. So, I mean, it's not a bad rate for the program. And he's a self-employed borrower and, has less than 2 year history, which most times people would hear that and be like, man, you don't have a shot. But yeah, he's closing in September and it'll be, I mean, it's actually a pretty easy program.
So, so just to recap real quick, we got somebody who's self-employed less than 2 years, which
Mhm.
by show of hands on here as real estate agents, if you hear self-employed less than 2 years, you just go, no, you're out,
Mhm.
right? So you don't have to say, no, you're out, right? She's got somebody self-employed less than 2 years, getting approved in the sixes, buying like a $1.7 million and make it more complicated condo. Am I wrong? It's a condo.
It's actually a townhome. I
It's a
thought it was a
townhome, but
condo.
it's not a
Mhm.
condo association.
Nope.
Okay,
It's got
good.
an association, but it's not a condo. He has
It's a
to
PUD.
everything. Yep.
Okay, so that's good. So,
But we're
and,
just using his 12 months of bank statements
yep.
and they take a calculation of that. You add up all the deposits that are in there and they'll take away certain things from that and take a factor. It can be up to 50%, but um,
No,
yeah,
the takeaway I
we made it
want
work.
here, the takeaway I want you to know as a real estate agent here is don't ever say no, right? Like at least send the person over and let us have a conversation with them. Because I met this guy at a networking group and he's like, bro, I can't get funded anywhere. Like, can you guys do it? And my answer is never no. Like, it's always like, I'm going to figure out a game plan. And then I didn't figure it out. Jenny did. And Jenny was probably working with Peg. And here we go, non-QM.
Yep.
And this dude, he didn't do ready, aim, fire. He did ready, fire, aim. Like he pulled the trigger on a $1.7 million home and didn't even have his financing teed up. Right. And now here comes Jenny to the rescue. Like, here's your financing. So thank you for sharing that. So the takeaway here is don't say no to something, like just send it over. Um, Peg, anything else on DSCR loans that you want to share that
Um,
would be pertinent?
Did you see
yeah,
my
I
question, Jeff?
Said it again?
Did you see my question that I posted to you?
I did not.
I just was
Oh,
wondering for the DSCR loans, is it only for people who have rental history experience, or can this be
ah,
for a newbie who wants to get into the,
good
start the
question.
there you go.
Yeah. Okay, so as I mentioned before, we have different investors that we send these to, and they all have different requirements. Some of my investors require that they are already an experienced investor, meaning they have a rental property already that they've had for at least 12 months, then they own their primary. I have other lenders who say, we're okay with the first time investor, as long as they own their primary. And then I have one lender who said, we're okay with that if they've never owned an investment property and they don't even own their primary. So they're a first time home buyer. The rules change a little bit.
Peg Squirrel's got to work a little harder on that treadmill, man.
But yes, we do
Yeah.
have a home for a first time home buyer wanting to buy an investment property all the way up to somebody who has 10 or 15. So it's a
Mm.
good,
That's good to know.
Yeah. So I did the one thing she said that I want to make sure we accentuate here.
the
And once she gets,
documentation required for especially the experienced investor. Like I have one right now he owns 15 properties. If he were to do a regular loan with 15 properties, he would have to give you the mortgage statement, the taxes, insurance, and HOA for every single one of those properties. We don't do that with the DSCR loan. We don't care. Um, we just want the information on the subject property. I do have to verify that all mortgages that are on his credit report are current prior to close. So that's important. And he does have to have a certain FICO to do the loan, but I think it depends on other factors, but typically I see about a 670, 680 or above. And then depending on your loan amount, how much you're putting down, that may change a little bit, but that's all you have to put in is on on the investment property, the purchase contract, your driver's license, social security card, disclosures. That's about it. So the
so
paperwork required is very minimal.
Do you take a
this is
full 1003 then? So like a full
Oh
regular
yeah,
loan application?
sure.
Yeah.
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 Okay.
Peg, this is awesome. So you saying that prompted me a couple questions, right? So number one, if I had a 20-year-old kid that's been working in the trades for 2 years and he doesn't own a primary residence, but he goes, hey, I want to buy an investment property, but he's not shown enough income on his personal income to qualify, he could do a DSCR loan,
Yes,
put 20% down if the property's paying for itself and buy his first investment property through a DSCR loan.
you can.
That's
Now it
awesome.
does require like a FICO, I think of about 700
Yeah.
on a first time home buyer. Um, and he has to, I think the LTV is probably 70 to
Yeah.
75%.
Yep.
And he has to have reserves, usually 12 months of reserves. But yes, it's doable. So if you've got somebody who's living at home, he's not ready to go out on his own, but he wants to get in an investment business. Yes, I have a home for him.
That's
Another
awesome.
little
And we're
bit
going
of
to get into
cash.
FICO. So stick around to the end because we got a FICO expert on here, Billy Alt. Nobody better. He's a consumer credit expert, witness in consumer credit. So we're going to talk about FICO and how we never say no on credit score, no matter what the score is, and how we get them there. But the other question I had for you on those, is there a limit to how many properties they can own?
Typically, no. There is a limit by investor. So if he's got, say, 10 loans with this specific investor, they may max that out and we may have to go somewhere else. But typically, no.
Okay.
I had a borrower last year who was buying a portfolio and there was, I think, 22 properties and we were able to send all of them except one to one investor. And the reason we couldn't send the other one is because that particular value of that property was less than that specific lender's minimum. So
Yep.
the loan amount was something like I want to say 85,000, and this investor we were working with has a minimum uh, loan amount of 100,000. So I
Okay.
did have to put one with a different investor. This other investor took everything else. So they really don't care. He, somebody called me the other day and they've got an investor who has like 40 or 50 properties. I don't have a problem taking that on.
Hey, I'm learning here too, because I was thinking I would have to go the commercial route on all these, and now I can leave these here. I can do these here at Stockton. So
Yeah.
the other question is Donald Bennett. He's very seasoned. I'll say that when it comes to lending. Don's one of the men in my men's Bible group that we meet on Thursday mornings. So he said, Peg, debt service ratio, does it have to be 1.2? Now I've heard it can be less than 1.2. So Peg, what do we have on debt service coverage ratio? Like what does that
You
need to be?
believe it or not, I have investors who will do no
I
DSCR
heard that.
ratio or less than. I have some that will go down to 0.75. The goal is to have our DSCR ratio of 1, which means the income, the projected income divided by the projected expenses gives you the DSCR ratio. And that ratio, we're looking for a 1 or higher. The higher it is, the better pricing you have. So if it does come in less than 1, we may have to flip it to somebody else if that particular investor doesn't allow going under 1. But we do have investors that will do under 1, and we do have a no DSCR ratio with one investor. So it's possible, if the person purchasing the property has a reason why they're doing it, even though they know they're going to lose money on it monthly, it doesn't mean that we can't do that. We can certainly do that. Um, so
And Peg, I'm just going to break it down easily for everyone else on the call who hopped on a little bit later. So DSCR means this, and I'm going to do even numbers. If you had a a a a mortgage payment with principal and interest, taxes and insurance that was $1,000 a month, and the rent on that place is $1,200 a month, that that DSCR is 1.2 because it's $1,200 to the $1,000. If you have $1,000 rent on $1,000 payment, that's a 1 because it's 1 to 1. If you have a $750 rent and the mortgage payment's 1,000, that's a 0.75. And so when Peg was talking about 0.75 or no DSCR, she was saying like we don't even need it, right? In some circumstances. So it goes back to what I said earlier. Don't say no, right? Like start that conversation with us and let's talk to the client to make sure they qualify.
one comment I wanted to make,
Yeah.
Jeff, is on how to calculate how the company calculates the DSCR or the income, the projected income. So if this is
Yep.
the purchase, when we order the appraisal, we order a 1007, which is the rent schedule. And then the appraiser determines what the monthly average rents are. And that's what we use to calculate the income. If it's short-term rentals, then and we know we're going to do short-term rentals because it's the area that the people live in. I always use this as an example in Gatlinburg, Tennessee. I have a group that works out of there, and they do a lot of short-term rentals in there because that's all that happens in there. So you can, short-term rentals could generate a lot more income than long-term rentals. So if we know that going in, we order the appraisal that way, and we specify to the appraiser that we want him to look at comps that are for short-term rentals, and we can even provide an Airbnb report. If it's a refinance and they've been doing short-term rentals, then they just need to provide, we still order the 1007, but we just ask the borrower to provide their annual Airbnb report. So we can use that. And I do have one investor who will take the higher of the two, the rent schedule versus the lease or the Airbnb report. So if somebody gets a rental average for that area of $2,000 a month, but this investor has been leasing it out for 3 years and he's getting $3,000 a month, we want to send it to this specific investor because we know they will allow the lease amount versus the rent schedule. So that's important to know too.
So and I didn't know that, so I'm going to say it out loud again. Like this isn't just for long-term rentals. You can do DSCRs for Airbnbs too. Right, Peg? Okay.
Yep.
And then Stephanie put in the
That's
chat, she
correct.
said, "Hey, what states are you licensed in?" We're in and it's a great question. And I don't know that everybody that's even working with us knows this. We're in Pennsylvania, we're in Ohio, we're in West Virginia, we're in New Jersey, we're in North and South Carolina, we're in Florida, and we're in Texas, and we're in Minnesota, right? So any of those, and and here's the thing, if you have something in another state, reach out because I'm a part of a loan officer network. I have been for over 10 years, and Stockton's in more states as well, and we can refer that as well. You can listen to this again on our YouTube channel, Lagoni Mortgage Group. Go out and subscribe. We have all the past replays on there as well, where we cover a ton of topics. So Lagoni Mortgage Group on YouTube is where you can watch this replay. The other question I have for you, Peg, is these are 30-year amortizations, which will help the investor cash flow better than going to a commercial lender that's going to be a 15 or 20-year amortization, right?
You could do it ARM products too.
So we can do ARMs, but it's still amortized over 30. So that still helps that lower
Yeah.
that monthly payment, and help that investor cash flow even better. Okay. Anything else about DSCR? Anybody have any questions about DSCR before we get into like self-employed loans?
Jeff, I just locked a cash out refi on a DSCR so that I have an investor that needed some cash and didn't want to tap their primary. So we're using DSCR.
I love that.
Let me interject on
Yeah.
that, Melanie. Because of the DSCR product and the purpose of the loan, if you're going to do a cash out refi, or your borrower wants to go do a cash out refi, the purpose of the cash out has to be for either buying additional properties, doing improvements on a property you own. I mean, not that anybody's going to go look at it after we close on the loan, but they do have to acknowledge the fact that that's what the cash out proceeds are going to be used for. So it needs to stay within the realm of the real estate investment business.
That's good. That's good. I didn't even think about refis on DSCR loans. I'm always thinking about those as purchases.
I had quite a few investors that are looking for cash to buy their next
Yeah.
investment property. So that's a nice way.
Yeah. So that cash out refi on a DSCR loan can be in an entity name as well.
Yes.
Yes.
Okay.
Now
Don
they
Bennett.
have to provide, the typical, the operating agreement, the EIN number, the articles of incorporation in good standing. All of those documents have to be provided before we can get final approval. But yes, and another option to keep in mind is we can do foreign nationals or ITIN borrowers.
Yeah. Yep. Please do. So real quick before we get there, because I want to get to those too. But Dawn Bennett had asked me a question about cashing out on some investment properties as well. I didn't realize that we could do that right here at Stockton. Like my brain goes immediately to commercial lending in local banks. But I'm learning something here on this call as well. So it looks like that's a possibility here too.
I have to look up what 1007 was.
Yeah.
Mr. Season, I had to look up what a 1007 was.
Yeah. Yeah, and she followed it up with it's the rent schedule, right? It's what they put. Yep.
Hey, Jeff,
how
Stephanie,
much can they?
oh,
What's
sorry.
that?
I was just telling you that Stephanie had a question.
Yep. She said, how much can they pull out? What's the LTV on a cash out for a DSCR loan?
It varies. Usually I would see a 75% LTV on a cash out refi. There is a max amount that you can pull out. And in most cases it's 500,000. But again, every lender is different. And it all depends on the file itself, the DSCR ratio, the FICO score. It depends on the strength of the file, but typically I would say 75% LTV and a max of $500,000 cash out.
How about roughly what are the interest rates on something like that on the DSCR?
Stephanie also asking about.
I knew you were going to ask me that. I can't talk interest rates. I'm not licensed.
Yeah.
I just meant a broad range. Are we
they are
talking
going to be a little
the...
bit higher.
Okay.
Yeah. Okay.
But like
so
slightly higher, not like you're not getting
yeah.
10%, right? Yeah.
No, typically, well, let's see. Let me go into one I have and I can tell you.
And while you're doing that, Stephanie asked, is there a minimum loan amount on a cash out refi?
It's the same, would be the same as a purchase.
75,000 or 100 grand.
100,000 to 150, depending on the investor.
Okay.
Like right now, I've got it's a cash out refi for a person who has a FICO of 772, and it's only $101,000 loan amount, but the rate is 7.625.
Okay.
That's not bad.
Yeah. That's not bad. especially with the ease
So
of the
your rates are going to
documentation.
be a bit higher on the DSCR loan than like a bank statement loan or another non-QM loan because it's the riskiest, it's a more risky loan than any other non-QM loan. Because we're not looking at income or anything. We're just looking at the subject property, income divided by expenses.
And the other part to think about, so just so we can define terms on this call, like when somebody does an investment property, there's something on there called LLPAs. It's called a loan level price adjustment. And a loan level price, like, so when you see banks advertise, hey, we have 5.5% today. Okay. That's a primary residence. Somebody's putting 40% down. Their credit score is an 850, right? And then your client calls us and we go, hey, the rate's 7 1/8. They had a 620 credit score. They're buying an investment property and they're putting 20% down, right? Like it's just everything's profile priced and those loan level price adjustments kick in. So a 7625 on an investment property is not that bad because the loan level price adjustments on investment properties are through the roof. But let's get into are there any other questions on DSCR loans? Like those are for buying investment properties, cash out refis, simple documentation. You can put it in LLCs. Because I want to get into the next one, which is what sparked this call in the first place, is self-employed borrowers. How do they qualify for a loan? Doing the bank statement loan program, Peg, and then how's that income calculated based off the bank statements?
Okay. The key thing with your self-employed borrower, and I know that Jenny was talking about somebody who was self-employed less than 2 years, but we do need to show that the borrower, if they are self-employed for less than 2 years, that they've been at least in the same line of work.
Yep.
So a plumber may be working for a company for 5 years, decides to go out on his own, and he's been doing that a little over a year. We can make that happen because he's been doing the same job. He's just now self-employed. So basically what we do, and there are different types of self-employed borrowers too. A real estate agent, for instance, may not
Yes.
be perfect in a bank statement loan because you work for your broker who gives you a 1099 at the end of the year, and this 1099 program might be a better fit for you. So you have to look at your self-employed borrower, what his situation is, how he's paid. If he owns an actual business, then of course a bank statement loan would probably be the best. But a P&L program might also be an option for him. But going back to the bank statement loan, typically we take the most recent 12 months of bank statements. And Stockton just launched an AI program that does the calculations for us. So I no longer have to do them manually. Yay. So I just take the 12 months of bank statements, throw it into the program, and in 5 minutes, I can get the monthly average income. It deducts anything like if it looks at all the deposits for the month. It deducts things like transfers from other accounts, returns or refunds, loan payments, anything that is deposited into the bank statement that does not appear to be an actual business receipt. So it then calculates it, gives an average monthly amount, and then it applies an expense factor. An expense factor, it just assumes in most cases that it's a 50% right off the top. But we have some lenders who say, well, not all self-employed borrowers are the same. What about the guy who's the plumber? He doesn't have any employees. He works out of his house. He just provides service. He doesn't sell any products. So they look at that. Some of my lenders look at that differently and say, well, his expense factor is going to be much lower than 50%. So we can look at that a little differently because typically if the borrower said, my expenses aren't 50%, we can't use the tax returns to prove it. So we ask them for a CPA letter that says, okay, here's my accountant. He's been doing my taxes for 5 years. He knows my business. He'll send a letter saying that, Joe Plummer expense factors are 30%. So there are options that we have to calculate what we're going to lop off the top of that monthly income. And it depends on the investor as well. So, but basically that's the gist of the bank statement program. We just look at the income that we see on the bank statements.
Yep. And I heard you say 1099 and P&L programs too.
Yes.
So
Now, the
how do those work? Yeah.
1099 is a great program. Well, they're both good, but the 1099 is really good if the self-employed borrower does get a 1099 because the expense factor that's assumed on a 1099 program is much lower because they're assuming, well, you're a contracted independent contractor for that company. You probably don't pay any expenses. The company pays it all. So most of my investors will do anywhere from 10 to 15% expense factor on those
Wow.
loans. And all we
Wow.
do is provide the most recent 10-year 1099. And then we also ask for something to prove that the year-to-date income is coming in to be comparable to what that last 1099 was. So it's even less uh, uh, documentation than you would normally see in a bank
That's
statement
good.
program. So just know that your self-employed borrower isn't always going to be best fit into the bank statement program. It could be the 1099. Or say he's got a business, but he does lots of things underneath that umbrella of his business. A P&L would probably work really nicely. And again, expense factors are based on the P&L itself that's prepared by the CPA. It does need to be prepared by an accountant, does not need to be an audited P&L.
Good. Yep.
And it has to be the most recent 12 months. So it's not going to be a January to December kind of P&L. And it can be a very basic one. It doesn't have to be a real elaborate. It could just be whatever the account is willing to provide. And it's just going to be your basic, here's all my profit. I mean, here's all my income, here's all my expenses, and here's what I have left. And they will usually use that. I predominantly see on a self-employed loan, the bank statement is probably the most common. And then the 1099. And I do a few P&Ls throughout the year, but not a whole lot.
Okay. And then the other thing I wanted you to talk about was the asset depletion, right?
Okay.
I think a ton of loan officers miss this. I know when Jenny first came on, she was doing asset depletion left and right.
Yep.
And those factors matter. So, and bottom line is if you have money in the bank, but you're not showing a lot of monthly income, asset depletion would help you qualify. And then Peg, can you talk a little bit about asset depletion calculations, what that
Yep.
looks like? Yep.
There are actually two different kinds of asset programs. One where you're looking at all of the monthly debt that the borrower has, and you're just saying, okay, well, here's what he's got. Here's what he's going to put down on this house. Here are the closing costs and reserves, and here's all his monthly debt. We're going to times it times 60 or 80 months, depends on the investor. And if he has anything left after you do all that, you're good. The other program is where you're converting those assets into an actual income amount. You're basically doing the same calculation as the first one, except you're not looking at all of his debt. You're just looking at you're deducting the amount of the loan, the prepaid closing cost, the reserves, and then you're taking what's left and dividing it by 120 months usually to get a monthly income. And then you plug that income into your loan like you would any other income to see if you qualify. So there are two different programs. Now, each investor will do their calculations a little different as far as how much of those assets it will count. So but most of the average is anything in any kind of checking, savings, money market account, you can count 100% of those assets. If it's stocks, bonds, CDs, things like that, it's 80%. And then retirement funds are typically 70%. Might get a little bit higher if they're retirement age, but typically it's 70%. So then there's a worksheet for it. You just calculated all that based on those percentages to get your eligible assets. And then you either, I always recommend the loan officers to apply both. Do it the income way or the total debt way. And then you just figure out whether or not he's got enough assets. There usually is a minimum amount and I think it's usually 500,000 that he must have. And some people make the mistake is they forget to deduct down payment on the house that they're purchasing before they do their calculations. So make sure that you're deducting the cost of the down payment plus the closing costs and so forth before you to get your eligible assets. It can
Yep.
get a little
Yeah.
complicated, so but it's really not. It's just a basic worksheet that calculates whether you either convert the assets into income or you don't. And you just, as long as you have money left over, you have enough assets to pay for that loan, those loan payments for a certain amount of years.
And
No,
they
that's
and they
good.
don't have to draw. They don't have to set up like a
No.
draw that they start getting
No.
on their assets, A
No,
lot of
and you don't
people are
have to
skittish when it comes to that.
yeah, you don't have to liquidate anything. You can keep it wherever it is because it's only going to use the percentage that it decides you can use. So it's just a really nice option for someone who isn't maybe just got
Doesn't
lots of
have to
money.
be a retirement. Do they have to be a retirement age? Because I know like on
No.
Fannie and Freddie, one does require 62 and one doesn't.
No, you don't.
Age
It just,
restriction.
but it might affect the percentage that's given to the asset, whether the retirement age or not. So
And
if
is
the
it,
retirement age, they might be able to use a higher percentage of those assets.
do they allow all kinds of assets? Because I know like on Fannie, they only they only allow you to use like Roth, IRA, retirement, things like that.
I've not found that there's there. I do have a couple lenders who don't like cryptocurrency.
Okay.
Although that's changing a little bit as we go further into that world, but typically they will allow it. They just may apply a lower percentage to get the eligible assets to be used in the calculation. But
No, that's
it's
good.
it's
Good to know.
yeah,
I mean,
and
the main thing to know is like if your client has money in the bank, they're not out. Like if they say they don't have income, it's okay. Like again, like just send them over, let us work through it.
Yeah, and
And
we
then
can do
Peg,
it
the
as a
last,
standard file too. I mean, it doesn't have to go
yeah,
non-QM. We can go with Fannie or Freddie. They do have an option there. So I mean, it's pretty great pricing. And it's just kind of an alternative solution to
yep,
no income.
helping them get
we
the
also
get
have
going.
I haven't talked about this yet. We have land loans. So we have investors that will do that. We have an investor who will do hobby farms. Like I get a lot of requests for people that have these, 40-acre, 100-acre properties, and they have trouble finding
Yeah,
solutions for them. And
Hey,
I
tell them
I have
about,
options for them.
Melanie,
hey,
do you have a hobby farm right now that you're working on?
yes, someone on this call also knows about this hobby farm. This is a self-employed, we use 1099s, non-owner occupied hobby farm. It just keeps getting worse, but we can write it.
Yeah.
That's crazy. Wait,
It
you
is.
said non-owner occupied hobby farm.
Yes.
That's wild.
Yeah.
Okay.
She's a veterinarian, so this is
Yeah.
where she runs her
Oh,
business.
yes.
Makes perfect
Oh,
sense.
I
Yeah,
remember
Peg
that
does.
one. Melanie and I have been talking about that one for quite a while.
Uh-huh.
We also have lenders who will do manufactured homes
Yep.
that are built before 1976. They will do
Uh-oh. We just had one of those. We just had one
yeah,
of those this weekend, built in
uh-huh.
1964.
Yep. And we have some that a lender who will take them, two lenders who will take them even if they've been moved from their original location.
Ooh.
So, don't just say no to your borrower, whatever situation you have.
Yeah.
We've come up with some really great solutions for people they've been all over and they can't find
That's wild. Before
financing.
1975 trailers. Jenny, I think we got to make a call back.
Yeah.
I just
Yep.
closed. I'm just closing on one today, built in 1970, I think, and
Yeah.
we couldn't even find the HUD tags or the VIN number because the house has had so many remodels and the entire building was, or the MH was bricked over. on the outside. There's, all kinds of stuff added. And we had to really search to find it, but we found the manufacturer serial number. So as long as the title company will give us that manufacturer home and Alta endorsement on the final title policy, I can close that loan. So it gets a little tricky sometimes, but that's the key thing about the investors that we're using. They think outside the box.
I
And
love
in
that.
most
Yeah.
cases, they really do common sense underwriting, which is really nice. Now, some of these products we underwrite in-house, so it's our underwriters that do the loan, and then sometimes we send it to the investor and they underwrite it, but everything else is done here. We close them here, we do all the disclosures, we process them here. So even if we do go out to the investor to underwrite, that's the only piece they do. We have control of everything else.
And so the last piece I wanted to cover, because I try to get people in here and out of here in a half hour, but this was phenomenal. Like I could talk this all day long because I
Me
think you just
too.
brought, I just think you brought back to life like 5 loans for us. And I'm sitting here preaching, don't say no to anybody. And I'm pretty sure I said no to somebody this weekend. I should have called you first. The I-10, right? So
Mhm.
ITIN, can you walk through that one real quick?
Yeah, the I-10, in most cases, the I-10 borrower, it's not a specific loan, it's the borrower type.
Yep.
So he can still do the bank statement loan, he can still do the DSCR, he can just still do whatever loan he wants to do with us. It's just that he's an I-10 borrower. I actually have a file right now where they're non-perm residents, they have a social security card, they had a green card. The wife is having trouble getting hers renewed, but she's from France. I have 2 investors who will honor the visa waiver um, policy that the IRS has, or that we have with certain countries where we don't require visas. So, because we were struggling with this one, and then we did some research and we discovered that in some countries they don't require that you have an ongoing visa. And I have 2 investors who will go with that. So I was able to find a home for it because she's having trouble getting her renewal on her visa. She's been here forever. And so there are options there. But an I-10 borrower, basically, we can run credit as long as we can run credit on their I-10 number. They don't have to have a social security number. And then we just pull the credit based on the I-10 number. They do have to meet the standard trade line requirements typically, although sometimes there's room there. And they can purchase any kind of a loan that they want and still be an I-10 borrower. Same with the foreign national. Well, let me retract that. A foreign national can buy an investment property. And we don't have to show proof that they have their primary because their primary is in another country. How are we going to prove that? So
Yep.
it's more relaxed for a foreign national on a DSCR loan than uh, another type of borrower.
And Peg, there's people spreading rumors about you in the chat, just so you know. Somebody said Peg is a wealth of information, but also the nicest, most patient person around. Yeah,
Thank you.
yeah. Um,
I try.
thank you for sharing that. Like that,
Yes.
like I learned so much today that I didn't even realize I didn't know, and I'm out here talking smack on other loan officers that don't know stuff, and we learned today. So like, hopefully these the agents on here learn, like, don't say no, just send them over.
Mm-hmm.
One of the other things I want to talk about is credit scores, right? And so, how many times have you had a customer that didn't qualify based on their credit, and do you just say no? Right. And for me, and if you could throw it in the chat, if that's been something of yours in the past, I lived this. So I don't know credit because I studied it. I know it because I lived it too. And I lived it because when I was a computer programmer in the late 90s, I was making $100,000 a year. When I got into this line of work, I was 100% commission. I didn't make more than $18,000 for like 5 years, 6 years, something like that. And I got crushed. My credit scores went from perfect to below 500. I think I was at a 480 at one point. And so I'm hiding my truck from the repo guy. I'm getting collection calls. And the thought that hit me at that point is if you have bad credit, that doesn't make you a bad person, right? Like when your credit drops, it's not because people just decide I don't want to pay my bills. Something happened. Like life hit them. They got a divorce, they lost their job, They got sick. They went into the hospital. Something happened where they can't pay their bills. Now, as I was pulling through that and starting to make money and starting to pay my bills, I'm like, if I ever get through this, man, I'm going to help other people get through this that go through this life event as well. And as I've looked through the years doing mortgages, what percentage of people you think when they call us don't qualify based on their credit score? Anybody want to throw a number out there? What percentage do you think it is?
40.
Yeah, it's like 50%, right? So that 50% of the population, I don't want to be that person that goes, no, beat it, you don't qualify, see ya, right? Like I want to be that person that goes, hey, right now, you may not qualify right now, but here's your game plan. And one of those things that we look at is credit restoration. Now, I became a certified credit consultant back in 2007. So I used to do this by hand for people. And then I partnered with a company back then. And what they would do is help you clean up your credit. I met Billy Alt probably 7 years ago at an event. Now, I will say this the most honest way I can. There are a ton of shady credit restoration companies out there, and I'll leave the name out of it because I'm not trying to get sued. But there's one out there that will charge you $100 a month for life until you say uncle, and they'll dispute one thing a month. They're just milking you for the money. I was looking to partner with somebody who does it the right way. Like sends the letters out correctly, does everything correctly, is experienced, is knowledged, and gets through it without running you over the coals financially, right? And that's Billy. So we've been sending customers to 700 Credit Repair for probably the past 5 years. And one story we have is a buddy of mine last year wanted to buy a $700,000 farm. He had a 560 credit score. And I'm like, hey man, talk to Billy. And what Billy will do is sit down and consult with him first. Like, what can we do? And if it makes sense, let's move forward. If it doesn't make sense, let's not do anything, but I'll just still coach you up anyways. Right. So he's not out just to make a dime. He's out there to help these clients for real. And so that customer went from a 560 to a 701 in 3 months and closed on their $700,000 farm. Right. So like the answer for somebody who doesn't qualify credit wise doesn't mean no. It just means like, let's put a game plan together for you. So Billy, having said that, can you just share with the group real quick, like your credentials, what you do, and if they wanted to use you, right? Like how could they reach out to you and get
Absolutely.
connected? Yeah.
So absolutely. Thank you all for having me. Thanks, Jeff. Hi, Jenny. Hi, Melanie. How are y'all? Good to see you guys. Jenny, I miss your hat. Your hat's not on today. Hey, real quick, a couple things that y'all may be interested in. Peg, that was amazing. And some things you said you have a passion for non-qualifying loans. And like the older I get, the more I realize the more you help others, the more you're helping yourself. You know what I'm saying? I didn't realize that in my 20s and 30s and 40s. I just didn't get it. And I think it's an age thing, right? But when Jeff says that he does not say no, he does not say no. Y'all don't. I mean, like I get that. I totally get it. And Peg said there are products out there that help people get a loan that can't get a loan. Not many people think that way. For me, I do not take no for an answer. I don't take no for an answer. I've never taken no for an answer. I got a 16-year-old kid that does not take no for an answer and can extract anything that he wants from me. Seriously. Yeah. I don't take no for an answer. If there is a will, there's a way. And there's a God. There is. And
Amen.
I just believe that, man, like if you want something, you can get it. Now, you got to put in the work and do some stuff. You know what I mean? Obviously, you can't have 400 credit score, no income, and blah, blah, blah. But these programs are ridiculous. First of all, I spent 18 years. I spent from the time I was 19 years old, 18 years. I spent 18 years in the mobile home business. I ran the #3 dealership in the United States of all companies, 6 years in a row. I was top 1, 2 or 3 years in a row. I sold a lot of mobile homes. We sold a lot of trailer houses. I mean, I was in it almost 20 years. And I've never seen a deal that was a pre-HUD tag home get approved. Nobody will do it. And the reason they won't do it is because in 76 is the year they started putting HUD tags on houses. And the reason they did that, they forced the mobile home business to stop using aluminum wiring and start using copper wiring. So anything pre-76 is an aluminum wired house. They won't touch them. Nobody will touch them. So that in itself is like, that's a huge deal. They put serial numbers on houses. It's just couldn't find the HUD tag because there wasn't one on it. So that in itself is crazy. Something else I'm hearing, if y'all are getting into the I-10 business, I do a lot of I-10 stuff down here. I breed and race Frisian horses. You got Jenny and y'all have heard me talk about it all the time. I deal with a lot of Spanish people. I deal with the Spanish community big time, big time. I got one of my best friends is an influencer in that space, 15 million followers on Facebook. He sends me a ton of business. We can do credit repair for I-10s. So if somebody uses their I-10 number instead of a social security number and they get a Visa card in a car and they're late on that car and their FICO score is reporting, we can dispute and work on that stuff as just like a social security number. Another thing that we do a lot of, y'all, that it fits right into this, I do a lot of business credit, credit repair and business credit. It's like y'all, mortgages, regular mortgages, all these different types of mortgages. Business credit's just another type of credit, is all it really is. So we do a lot of business credit, and I have a lot of customers that will do these types of loans, but then they'll do a straight a true commercial loan through business credit. We sell business credit also. I don't do the funding, but we build it and create it. We stack it. We take somebody like your customers who owns a business. We say, hey, okay, now let's go get you some $50,000 business credit cards. I've got right now 4 cars, 3 of them are in my parking lot that are financed solely in the name of 700 credit repair. So business credit falls right in line with this. Business credit would be something that you guys could add on or sell, because I sell my little program for $500. It's super cheap. But the value to your customers, to your people, could be a lot. If you've got investors that are buying 2 and 3 houses from you, I would say, hey man, hit up my guy. We should start building you business credit, because business credit's a second social security number. My 16-year-old kid's truck is in my company's name. And quite frankly, the reason is if he hits and kills somebody, I'll change the name to 701 tomorrow and I'll rock and roll. And that sounds probably disgusting. I don't mean it like that. But what I'm saying is, if I was a realtor, I would want my car in my company's name. I wouldn't want to get rear-ended and then lose everything I got or whatever. And I know that may sound like way out there, but I'm talking for people that are doing, I got realtors in town that take people, drive them all over town. And to me, that it's scary. But anyway, we can do business credit as well. How we do, what Jeff wanted me to talk to you guys about quickly was how we do credit repair. Our deal is very, very different. We have a home ownership guarantee. We guarantee our clients that we'll get them to at least a 620 in 180 days. That's 6 months. Or we would continue to work on it for 6 months. After that, I'd refund their money. The only reason that they do not accomplish what they want to accomplish, and that's raising their score, is because they may get a new slow pay on their truck. They may get a new collection. They're working against us. So for us, we sit a customer down. We wrap with them. We say, hey, what made you reach out today? Talk to me. Okay, yep. I hear you. We can probably help you. We pull their credit, no inquiry. We review their credit with them, and we make 4 or 5 different game plans. We say, look, you got 20 negative items, 1 positive. Here's some things we could do. We could work towards getting 10 of them removed. You pay down this balance and you open this 1 card I tell you to. That game plan is going to get you 144 points. No ifs, ands, or buts about it. Let's say we get all 20 deleted. Now you get 200 points. Let's say we get 4 deleted. Maybe we got to pay this down to 50% and open up 3 cards. Now we're at 640. So we lay out multiple game plans, because when I dispute things and I work towards getting things removed, that stuff is accurate information. If Jenny comes to me and says, hey, there's a repo on my credit report and it's not mine, I'm going to say, we're going to file a police report and it will be done in probably 20 days. Well, that is my daughter who did there's no police report available then. We can't put her in jail. So now I've just got to dispute it, because now it becomes accurate information. So I can't guarantee that I can remove anything, but we average a 78% deletion rate, because I don't take no as an answer and they don't take no for an answer. So it's not like we have to get everything removed, or we have to do what my job is to manipulate the score enough to where Jenny can get somebody into a house. It's just that plain and simple. And there's a way to do that, because I know this, if I remove bad and I add good, the score does nothing but go up. It has to go up. The question is, how many of these 25 am I going to get gone? I'll get rid of enough of them. The next question is, you've got a Visa card, 1,000 limit, 1,000 balance. Can I get you to pay it down to 800? Can I get you to open 1 more $300 credit card and not go straight to the liquor store and fill it up, max it out? That's the question. You know what I'm saying? So because that's what we see. That's what that's what the borrowers typically do. If I tell somebody go open up one more new credit card, here's a little guaranteed link, $300. If I don't have a serious conversation with them, they'll go max it out and their score actually drops. So 18 years in business, we've seen it. My wife was actually my operations manager when I was in the mobile home business. She worked for Wells Fargo in the mortgage division for 10 years. Also, I see what makes things fall apart on the back end. And we don't really look at a deal like, I want to sell you, Frank, I want to sell you. We look at a deal like, brother, it's this easy, man. If we do this, and this, here's the outcome. The people lie, the math, the numbers don't lie. Out like the data does not lie. So for us, we're very, very passionate about like we don't take no. I'm like Peg, like there's if we can get this worked
Yep.
out, it's just not like the second. So for us, we're very customizable, very customized. We are very one-off. We don't do form letters. He won't say it, but I will. Lexington Law will charge you $129 a month for 18 months. That's their business model. And I have a little insurance company, a health insurance deal that my great uncle owns that he cut me on a little deal of as a partner. I don't make any money off of. I don't know what the deal is, but he's actually his company is the largest merchant company in the United States. He started POS systems in the 80s. He does Lexington Law's credit card processing, and they bill $7 million a month is what they bill.
That's insane.
And
Yeah,
their
yeah.
results are absolutely horrific. They're terrible. They really are.
Terrible. And anytime somebody says that, I'm like, stop the bleeding and let's
Don't
get you
do it.
connected to the right people.
But
Yep.
for us, the big thing I want to, let you guys know is we're very, very custom.
Yep.
It's just like Peg talking about, okay, do we go DSCR? Do we go this? Do we do that? Do we use it? That same thing with us. The same thing with us. I'm not a cookie cutter. I'm not going to put your information in and do a bunch of form letters and just send them. We're not. My girls are in there going through stuff and figuring out like little things like a repossession. Whenever a car repos, I don't know about y'all, but for us older guys back in the 80s or not 80s, I'm not that old, 90s, like if I was late on a truck payment, I could call Chevy or Ford Motor Credit or GMAC and say, hey man, times are tough. Can you help me out? And they say, yeah, no problem. We're going to put one note on the back of your term. Now it's a 61-month term. So we're going to let you skip this month. We're going to add a payment to the end of your note. When a car repos, that's the first thing they do. The collectors are trying to make that portfolio, that paper clean, current. So they want to get you current. When they add a payment to the end of the note became 61 months. It's no longer 60. On the credit report, it's going to show terms as 60 months. So we're very one-off. We try to trap them. And if we can't, we can't. But like that's kind of what we do. So we're very, very custom, very one-off, very dig in, roll up our sleeves and get after it. We process somewhere in the neighborhood of 600 clients a month. And we could probably double that. My girls are that efficient. We built and created our own software 4 years ago. So we're just very productive. We're just,
Yeah.
so.
And Billy, we got a question in the chat. Chuck Logan, again, he's actually the man that leads the Bible group that I'm in on Thursday mornings. He said, hey, Billy, and I know the answer to this question, but I'm going to ask it out loud. Do you also build credit from scratch? I have a
Yes.
17-year-old who wants to get into investment properties, would like to know where the best place to start building credit. Billy, should I just get them connected to you?
Yes, absolutely. But
Yep.
Chuck, yes, we have a credit builder program, and Jeff always brags on our company about this. Like I'm quick to give information instead of charging people or whatever. But what I would do with him I would look for me. I've got 5 kids, 4 of them are grown 30s. I put every one of them on a Capital One card and American Express card. They're probably still on it 10, 15 years from now. So if you have a card that you keep a low balance, you don't give them a maxed out card. If you have a Capital One, American Express, Discover, low balance, high limit, you could add him to that card. He immediately, now there's got to be some common attributes, i.e. a last name, same address to the credit reports, something like that. If that is the case, which it will be, he'll immediately get the benefit of the age of your accounts, that account. He would get the utilization off that account. So if you've got a 10-year-old Cap One card, you can slap a 10-year-old Cap One card, authorized user, and I know he's with you, but don't give him the card. You don't have to give him the card. Keep the card and rip it up or whatever.
Jeremiah, go run it up, kid.
Yeah, and then
Yeah.
like
Yeah.
it's not like he can call and get a new card. I know he's on here. Sorry, but I'm just kidding. But
Hey, Billy,
you know, just
when I was 19, my parents added me to their Sears card that was opened in 1964.
yeah.
And
You know, that's so
I was
funny
like,
because my parents did the same thing for me when I was 18 and
yeah,
an American Express. The American Express is still on there, but when Sears went out of business, the Sears dropped off. But my Sears card showed that I was like 4 years old when I got the card. It was ridiculous.
same. Yeah.
Yeah.
And
So,
it was
but
done
yeah,
less for us that it helped me, but
and then Chuck also you can go to if he has no credit, you could go to like Capital One. They have student cards. You could sign with him on something, but he could probably if he has no credit, he could probably go get a Cap One card right out of the box with no security deposit or anything. Worst case scenario, they may say, you know, give me a $200 deposit. Credit One's another really, really good starter card, and they're real good about starting at like 250, but then every 3 months, 90 days, like clockwork, if you pay on time, they'll up you $100, $100, every 3 months they'll do it and like clockwork. And so I actually did it a long time ago, and I just got one from them for $1,000 increase. I got a card, no joke. I can show you the paper trail. Started at $250, $200, I think, actually, and it's like at 2,500. That's not a lot, but if you go from 200 to 2,500, it is. It's been 10, 20, 15 years since I've had it or whatever. But anyway, Credit One's another good one. Adding him as an authorized user is a good one. Store type cards are really, really good ones. Best Buy, Amazon's easy to get. Walmart's easy to get. And for y'all, and there's another thing for y'all to know. If you've got somebody with like a 570, 580 credit card, Amazon, Walmart, those store type cards will hook them up. The problem is that buyer usually will go max that card out and then it drops their score. So that's why I tell realtors and LOs, stop doing credit repairs, stop talking credit. Here's what you used to say about credit. Oh, you got some credit issues? Let me do this. Go talk to Billy. Here's his number.
Yeah.
Here's his phone. That's what I would do. I would say this,
Yep.
I've seen this company make miracles. They've been in business 18 years. We've helped over 25,000 people repair their credit document. I've got over 25,000 signed contracts in my possession. And so just send them to me. Just send them to us. I can give y'all our number. They can call us. You can, and if you really want to get serious, get with Jeff. We can get on a one-on-one call because we have a portal. We have all kind of tools we give our realtors and our people that we work with and stuff like that. So yeah, I'd love to, if we're not working with you now, and hopefully Jeff gets all of your business. So I look at your stuff anyway, but in the event you've got other stuff going on, you still reach out to me and I'd love to help you.
Billy, what's a good phone number? I'm gonna throw it in the chat because
our office number is 972-279-0444. And Jeff's person here is Alexis. She's actually my daughter. And her extension's 117. Great. She's been with me 6 years. Ask Jeff and Jenny. She's amazing. She's a girl, account rep. My other people are guy salespeople. There's a huge difference in a guy salesperson and a girl like account manager. That's Alexa. She's very organized. She's she's great. She handles all Jeff's stuff. So you can reach out to her. Let me give y'all my cell phone. If you have a customer, have them call the office for Lex. But if you guys have something, if you need something, Chuck, if you want to talk more about your son, if anybody has a question for me, my cell phone is 469-338-3142. And my our website's simple. It's 700creditrepair.com. And
For those of
700
you who didn't write down that cell, write it down because I assure you, you will want it and need it. And yeah, so awesome.
Thanks, Gene.
Thank
Yep,
you.
and I just threw that all in the chat for you guys. All right, we're over time, but this was phenomenal. The stuff we covered today, I will tell you, well, I'm going to say 100% of loan officers don't know. Like, because I'm a loan officer and I didn't know half the stuff that we were talking about today as Peg was unraveling it. And then what Billy does, right?
Most calls I get on, guys, and I'll shut up. Most calls
Yeah.
I get on, it's people saying all of a sudden Chuck or Frank or whoever will pop in and say, "Oh, it's slow," or "There's no leads." Y'all are sitting here saying, "We're not saying no. We're going to do this, or we're going to do this, or we're going to do this, or It's called irons in the fire. The more irons in the fire you have, the more successful you will be. That's just the way it is. I love it, man.
Yeah.
Story.
Phenomenal call. Thank you, everybody.